Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden, and these are the stories that set your agenda. Letters in the post. Stocks slide as President Trump says he'll start sending tariff notifications today, with some levies as high as 70%. They're set to come in on August the 1st. And Donald Trump notches a major win as his signature $3.4 trillion tax bill passes Congress. He's set to sign it this afternoon. Plus, India's regulator bars Jane Street from the local securities market, accusing the US trading firm of unlawful gains. A very good morning. Welcome to the programme, everybody. If you're just joining us, it's gone 6 a.m. in London. I'm in Dubai today, but let's take a look at the futures picture for you, because we are weighed down by the latest tariff headlines from Donald Trump, his warning that he's going to be sending these tariff letters out today. Some of these tariffs could be as high as 70%. We don't know where these letters are going, but look at the futures picture. Weaker on both sides of the Atlantic. It is, of course, Independence Day stateside, so US markets, in terms of cash trading in stocks and treasuries at least, are closed, but these are thin volumes elsewhere, and you can see it's a miserable picture. It had been a positive end to the week. Yesterday for the S&P, a fresh high, a fresh record off the back of the jobs report, killing hopes, at least in markets, for a July Fed cut, but a different picture today. Just flip the board over to the cross-asset picture. Let's see what we've got here. We've got the dollar having pared some of the earlier losses off the back of the trade news, but euro-dollar still up at a 117 handle. Brent at $68 a barrel as we look ahead to that OPEC Plus discussion on Sunday, the expectation being for a fourth straight production hike, and oversupply concerns now the main concern, not so much the case as we had heard when it was the Iran-Israel conflict. And then we have gold trading at $3,341 a troy ounce. Gold set for a weekly gain as traders weigh these concerned on trade against the lower odds for Fed cuts. But let's get over to Avril Hong now. She's got an update on Asia markets for us out of Singapore. Hey, Avril.
Hey, Lizzie. Yeah, we've been trying to digest some of these tariff headlines that we've been discussing in the last hour, that countries will start paying these tariffs from August 1st, but they're still watching out for these tariff letters, and the range that could be implemented with these levies still quite large. So I think investors are still watching out, wanting more details. They had already been cautious even ahead of this going into the weekend. So Chinese stocks, which were on a lunch break when those headlines dropped, they are showing a pretty muted reaction, although they are holding on to the declines from earlier on in the session. Now, investors are also worried about how the Vietnam transshipment tariff deal could form a sort of template for future trade pacts, and add to that how China has said that it will retaliate if its interests are hurt. So overall, it's risk off in the Asia Pacific. Let's flip the board and take a look at what we're seeing in Japan as well. The Prime Minister Shigeru Ishiba has talked about how there has been progress when it comes to trade talks with the US, pushing back against the notion that there's been a slow grind when it comes to trade talks. That being said, it's mostly risk off, as I said, in Japan, particularly when it comes to auto stocks that have been the underperformers for much of this year. It's interesting, we had the likes of fund manager Aizawa saying that the tariff sell-off could actually prove a sort of opportunity. They think that the automakers will be able to pass on higher costs to consumers at the end of the day. Aside from that, we also had data out of Japan today, which backed the case for more BOJ rate hikes and further firmness being seen in the Japanese yen against the greenback, Lizzie.
Okay, Avril Hong, we thank you so much for that update. Now, I just want to get to some breaking news out of the aviation sector. And this is that Air France-KLM is going to boost its stake in SAS to 60.5%. It's currently 19.9%. And this is really extending the consolidation in this industry and trying to compete with rivals like Lufthansa and the British Airways owner IAG. Now, it looks like the Danish government is going to continue to hold its 26.4% stake in SAS, US keep its board seats. This is according to the statement. But as we know, the European airline industry really has been consolidating in the aftermath of the pandemic. So another step in that story, Air France-KLM saying that its rationale for increasing the stake is the, quote, significant improvement in the airline's financial and operational performance. So we shall keep an eye on that at the open. But let's get back to the trade story. President Trump says that his administration will start sending out these tariff letters settling unilateral tariff rates later on today. It comes just 5 days before Washington's July 9th deadline, self-imposed deadline for these negotiations, with many trading partners still struggling to finalise deals.
We're going to start sending letters out to various countries starting tomorrow. We'll probably have 10 or 12 go out tomorrow. And over the next few days, I think by the 9th, they'll be fully covered. And they'll range in value from maybe 60 or 70% tariffs to 10 and 20% tariffs.
Well, let's get more detail now with Bloomberg's John Herskovitz. John, thank you for being with us. We've got this more detail from the president in the past couple of hours on his tariff agenda. Just take us through what he had to say.
Sure. So we heard the president say 10 to 12 countries, letters going out today. The ranges could be from 10 to 20% to 60 to 70%, which is actually higher than what he announced when he first rolled out the tariffs in April. We don't know what the countries are going to be yet. A lot of countries are still in talks with the Trump administration. We had Vietnam making a deal. India has been close to a deal. Japan, South Korea are far from a deal. But the one thing it seems like we're going to get is that anything that's agreed to is going to be piecemeal, transactional, and probably will have some sort of focus on China, trying to limit that country's ability to trade with China, as happened with the Vietnam deal announced earlier this week.
Well, interesting you mentioned China, John, because, of course, China, meanwhile, is going to cancel part of its summit with the EU. What do we know about that?
Sure. It was just a reflection of the ongoing tensions for things from, that started with the restrictions last year for China's EVs going into the European market, which were met with retaliatory tariffs. And we're seeing things like EU worried about China's support for Russia in the war with Ukraine, the flow of rare earth metals into the European bloc. And it's, the one thing that is also a part of this is as the EU nears a deal with the U.S., China is perhaps worried that that deal could hurt its interests. Beijing has said that it's going to go after countries that strike deals with the U.S., which hurt Beijing's bottom line. So this is also something which could be weighing into the friction between the EU and China.
All right, John, we thank you so much. Bloomberg's John Herskovitz with an update there on trade. Now, staying in the US, a better than expected US jobs report has eased the pressure on the Fed to cut rates. Let's get more with Bloomberg's Valerie Teitel. Val, it looks like July, at least in traders' minds, is off the table.
Yeah, it was because of this decent string of data yesterday, Lizzie. A big beat when it came to payrolls at 146 with a 106 expected. There also was an unexpected drop in the unemployment rate to 4.1%. Jobless claims also came in lower, and there was a beat in ISM services. This big bucket of decent data from the U.S., all from the month of June, is really posing questions. If the U.S. economy isn't feeling the impacts from tariffs by the month of June, is it really ever going to feel the effect of tariffs? It does seem like the U.S. economy is still in a solid place. All of this narrative has led to a repricing of the Fed's path forward. Those two-year yields rose abruptly yesterday in the session, around 10 basis points, as we really start to doubt a Fed cut in July. And Lizzie, doubts are even growing on a Fed cut come September at the later end of the summer. The U.S. equity market also responded very positively to this. Even though the Fed cut has been more priced out, the U.S. Equity market did rise. On the back of that, we did have a record run for the S&P 500 and the NASDAQ 100 to start this holiday weekend.
All right, Bloomberg's Valerie Tytel, thank you so much. Of course, the S&P hitting that record just in time for the holiday. Let's have a look at what's on the docket for today, because, of course, US markets are closed, so we've got to keep ourselves busy with other things. Lots to do, though. There's German factory orders at 7 a.m. London time, and at 9:30 a.m. London time, we get the latest S&P UK construction PMI. So interesting to get a read on the UK economy, given all of the concerns we've had this week on the fiscal position of the government, and of course what they need is growth, so that the Chancellor has less pressure for tax rises later in the year. We'll discuss that later on in the programme, but coming up, you can get a snapshot first, though, of all of these stories that you need to know to get your day going by going to the Daybreak newsletter. Just find it on your terminal by going to DAYB Go. There we have the President with his tariff letter threat headlining that this morning. And coming up on the programme, we're going to go into the other Trump story this morning, which is, of course, his big, beautiful win, passing the big, beautiful bill in the House. We'll discuss the implications of that sweeping fiscal policy shift next. And then later in the programme, as the Prime Minister here in the UK approaches a year in office, we'll assess the damage done to Keir Starmer by this week's parliamentary rebellion over welfare. So don't miss that. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, it took an all-nighter, but they got it done. President Trump's $3.4 trillion fiscal package passing the House just in time for the president to sign it by his July 4th deadline.
There could be no better birthday present for America than the phenomenal victory we achieved just hours ago when Congress passed the one big, beautiful bill to make America great again.
Let's bring in Bloomberg's Jill Desis for more now. Jill, thanks for coming back on. Just talk us through who won and who lost out of this bill.
Well, I think when you look at this bill, Lizzie, you're looking at, a few really big capstones here for Donald Trump. First of all, he gets extensions and further tax breaks. So, you're looking certainly at, even some of the wealthier Americans, getting some of those tax breaks. You're looking at some pretty significant spending to social safety net programs like Medicaid. And you're also looking at a pretty significant rollback of some of the Biden administration clean energy initiatives. So, I mean, that's pretty clear as day here. I'm also struck by a recent analysis that was done by the Budget Lab at Yale University when it was looking at the Senate version of this bill. That's the version that ended up passing the House just now. Really, the final version of this bill, looking at the fact that this tax cut bill will cost the bottom 20% of taxpayers an average of $560 a year, and then giving an average boost of more than $6,000 to those at the top end. So just spelling that out there, you are looking at some pretty significant tax cuts. You're also looking at some pretty significant cuts to spending on programs such as Medicaid.
Yeah, and even though you've got those spending cuts, the final version costlier than the House's version. I mean, how much blowback are the Republicans going to get at the midterms next year?
Yeah, Lizzie, I would suspect a pretty large amount of blowback. I mean, a big part of the deliberations over getting enough Republicans on board to vote for this thing in the House. I mean, remember, there were only 2 Republicans who ended up joining the Democrats in voting no against this tax bill. A big question mark for a lot of them was, well, on the one hand, you did have some of those ultra-conservatives who wanted even deeper cuts, but then you also had, quite a few of those, more moderate conservatives that are based in swing districts who were really worried about how much those safety net spending cuts would actually have on their constituents. And so we're already beginning to see the Democrats sort of formulate this plan. They, are calling this sort of a reverse Robin Hood bill. I would really, really highly imagine that this is going to be a pretty central focus point for Democrats that are ultimately trying to win the House back when it comes to the midterms.
And Jill, it seems like because of the momentum around the big, beautiful bill, the president's got the wind in his sails. He's come out with these comments on trade. Do we expect more of this sort of rhetoric as we head towards the July 9th deadline?
Yes, well, Lizzie, I think, what you've heard from Trump is that he really wants to stick to that deadline. Obviously, as we've been discussing, now he's coming out saying that, these tariffs will kind of go into effect. The latest tariffs will go into effect from August 1st. He plans on sending letters to a bunch of countries, basically just saying this is what the rate is going to be. If you're Donald Trump, a huge part of your economic plan was balanced on two different things, right? This big, beautiful bill, all of the tax breaks and spending cuts that he wanted to incorporate into that, and then also sort of propping up, this sort of, grand tariff plan where you are actually offsetting the impact of some of those, tax breaks and such with revenue that you're pulling in from tariffs. I think if you're Donald Trump, you've had this 90-day deadline kind of hanging in the air since April as Liberation Day on trying to make all of these agreements happen. But ultimately, it does seem like at this point, what he's saying is that he essentially just wants to set a bunch of tariff rates again. How this ultimately differs from what he originally announced back on Liberation Day, I think we'll have to see once, we actually see what these letters contain. But he's saying that he wants to float tariff rates on nations of, anywhere from 10% to 70%. So I think obviously a lot of uncertainty over what exactly this looks like. But I think we are looking at a very, very emboldened, very happy Donald Trump right now.
All right, the strategic ambiguity continues, but a happy president, as you say. Bloomberg's Jill Desis, we thank you so much for the update. Well, coming up on the programme, India's regulator temporarily bars Jane Street from accessing the local securities market, dealing a severe hit to the US trading firm. We'll bring you more on that decision next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, India's market regulator is barring Jane Street from access to its local securities market. SEBI also plans to seize $570 million of what it calls unlawful gains from the US trading firm after an investigation into derivatives trades that generated billions of dollars. Let's get the details now with senior reporter Abhishek Vishnoi. Abhishek, thanks for bringing this to us. It's a rare instance, isn't it, that the regulators find an overseas entity. Why have they started now?
Yeah, it is a rare instance, and this might be possibly a record fine, not just in context of foreign entity, but overall that SEBI has taken on any entity, by the local or foreigner. So, if this fine of $570 million that SEBI has imposed on Jane Street stays as it is, and there is no settlement, and the fine materializes, this will be the biggest ever fine that SEBI has imposed ever on an entity like Jane Street. Now, why now? Well, Jane Street's strategy of minting a lot of money through India's booming derivatives markets came into highlight last year when there was a case in the US with their rival Millennium. From that point onwards, regulators were watching out for what's happening in Indian equity cash markets as well as derivatives market. And there were separate probes that were going in. I think NSE closed their probe into what was happening in terms of such kind of trades of market manipulation, in May. And then SEBI got the data, got the understanding that it was looking for, and it culminated in such a manner that in 3-4 months' time, this order has come into being. Now, beyond that, beyond the timing, one thing that also is looking slightly odd is that this order is coming at a time when India's biggest exchange, NSE, is also looking to do an IPO. So that makes it a bit weird because NSE commands 80 to 90% share in the derivatives market, and this sort of weighs on its valuation, if at all, because this kind of order, this kind of crackdown, this sort of sends chills down the firms like HFT, those involved in proprietary trading, etc.
Yeah. So what's been the response from Jane Street then?
So Jane Street is contesting SEBI's claims, and they are saying that they are going to work closely with the regulator. SEBI's order shows that Jane Street has 21 days to reply and comply. Now, this is a temporary sort of restraint against Jane Street. If they do pay the fines, or if they are able to settle the case, they can start trading from the next day. But this definitely means that regulator is not happy with the way things were happening, or things were allegedly getting manipulated in cash and futures market. So therefore, for HFTs, for proprietary trading firms, it is very easy to expect that there would be some sort of regulations to ensure that enough guardrails are in place now, and all these kind of market inefficiencies that people were able to exploit in India would get closed. I mean, there is a big context here. India is not 10% of the world's market value in terms of equity market capitalization, but it's the world's biggest derivative market by contracts traded. And Jane Street were making 10% of their revenue from India. So that is a very big context, and regulators as well as the regime doesn't seem too happy about India dividend going this way, in the derivatives market and going out of India.
Okay, excellent reporting. Our senior reporter, Abhishek Vishnoi, thank you so much for bringing it to us on Daybreak Europe. Now, I want to zoom out, I should say, from India to the whole of the BRICS, because, of course, Rio de Janeiro is hosting the annual BRICS summit next week, and the bloc's really seeking to strengthen their ties amid the US trade war. Now, Donald Trump's America First agenda has opened the door for the BRICS to challenge the US-led global order, and Bloomberg Originals has been exploring the bloc's rising economic and political clout, and really whether it can truly unite as a counterweight.
This is a story about how the world's most powerful, richest country is slowly losing its influence.
And it's evident here.
We can see across Brazil, thousands of Ford cars almost disappear.
Meanwhile, China's BYD is becoming increasingly common. It's evidence of the growing connection between Brazil and China, the B and the C of the BRICS Plus coalition. This is a group that hopes to rival the US-led G7.
Over time, more countries started expressing interest in joining BRICS. So now there are 10 countries.
10 countries equals economic power. Look at how the original BRICS have grown compared to the G7 in terms of global GDP since 2009. It surpassed the G7 in 2019. Now add in the expanded lineup, and its share is nearly 40%.
The trajectory is clear. BRICS countries are growing faster.
This mantra,
America first,
has created an opening.
The trade war increased the solidarity between BRICS nations.
They want a multipolar world in which there are multiple centers of geopolitical influence.
But can these countries unite to become a meaningful global force?
It's very effective as a symbolic grouping, but how that evolves is probably going to depend to some degree how all their individual economies do, how they perceive the US is moving economically and politically, and how seriously they themselves want to move on big global issues.
Well, subscribers can watch that documentary right now on the terminal and at Bloomberg.com, as well as on the Bloomberg Originals YouTube channel from tomorrow. Don't miss it. Well, just another top story for you as well. Russia has launched a massive drone attack on Ukraine's capital, Kyiv, hours after a call between Presidents Trump and Putin. Trump expressed frustration at failing to make progress towards an end to Moscow's war on Ukraine.
We had a call. It was a pretty long call. We talked about a lot of things, including Iran. And we also talked about, as you know, the war with Ukraine. And I'm not happy about that. I'm not happy. No, I didn't make any progress with him today at all.
Coming up, almost a year since Prime Minister Keir Starmer took office. We'll discuss. Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in Dubai, and these are the stories that set your agenda. Letters in the post. Stocks slide as President Trump says that he'll start sending tariff notifications today, with some levies as high as 70%. They're set to come in on August the 1st. Donald Trump also notches a major win as his signature $3.4 trillion tax bill passes Congress. He's set to sign it this afternoon. Plus, India's regulator bars Jane Street from the local securities market, accusing the US trading firm of unlawful gains. Those are some of your headlines this morning. Welcome to the programme if you're just joining us. It's 6:30 a.m. in London, and you're looking at a miserable futures picture this morning because of the latest headlines from Donald Trump on trade, threatening to send out those tariff letters, and so ramping up the pressure ahead of his July 9th deadline. We had hit a fresh record on the S&P yesterday off the back of the jobs report and the expectations that the door's been slammed to a July Fed cut, but it's not such a rosy picture anymore, though it is, of course, a holiday stateside for Independence Day, so no trading in cash treasuries or US stocks, and then thin volumes elsewhere as well. Just flipping over to the cross-asset picture, in terms of the reaction to the jobs report, you'd seen yields and the dollar up. Now the Bloomberg Dollar Spot Index is on the back foot because of the trade headlines. We've got Brent at $68 a barrel, so holding this decline ahead of the fourth straight production hike that's expected from OPEC Plus on Sunday. But we have gold set for a weekly gain here as traders weigh the lower odds for Fed cuts against the lingering concerns on trade. So gold at $3,340 a troy ounce. Now, to the UK, some degree of calm has returned, at least for the markets in Britain, with Chancellor Rachel Reeves underlining her commitment to fiscal discipline and reassurances about her position from the Prime Minister Keir Starmer. Now, the market moves have really underscored the fragility of Britain's economic position as the Labour Party marks 1 year in power. Let's get more now from Bloomberg Opinion's Rosa Prince. Good morning, Rosa. We've seen the Labour Party promising to make growth its top mission. So really, as we review this first year in office for Starmer, how's the party doing so far?
Yeah, not so great. As you say, I think they thought that they could put everything into growth as a way of balancing those books. But it's easier said than done. You can't just press a button and suddenly achieve growth. So there are some measures which have been successful. They've put through some planning reforms and greenlit a lot of infrastructure projects, which I think they hope will achieve growth in the longer term. Shorter term, not so much, particularly that budget that Rachel Reeves herself unveiled back in the autumn, which really hit businesses hard and led to a lack of investment, a lack of job creation, and the figures speak for themselves, really. I think we're on course for growth of about an anemic 1%.
And what have been the wins this year?
Yeah, it's not been all bad. I think if you'd asked Keir Starmer at the start of his term whether he thought he'd do better on the domestic front or the foreign realm, I think he would have said domestically. But in fact, he's proved rather an adept world leader. He's handled President Trump in particular better than most other world leaders. Britain has signed 3 important trade deals, India, the European Union, and that trade deal with America. And I think it's been the only country so far to manage to mitigate some of those tariffs you've been talking about this morning. So that's probably the big policy win from him.
And of course, we've got to talk about the chaos this week, Rosa. The drama really centring around Starmer's forced U-turn on welfare reform. But there have been a series of walkbacks recently. Looking ahead, what are the challenges that he's going to face in terms of seeing through his big agenda?
I think the major challenge, and the thing that everything comes back to really, is that this government is so boxed in on its room for manoeuvre on the economy. So, as we were saying, he had wanted to get some growth going in the British economy and really be able to fund those projects that he cares about, like improving public services. The growth hasn't come. They had hoped then to make the numbers add up by doing some public sector cuts. And as the welfare reform debacle showed this week, that's proved harder than they expected as well. So that really leaves only breaking the borrowing rules, which Rachel Reeves again committed to not doing. She says that she will continue to balance the budget and that borrowing will not rise. Then we've only got tax rises left, which again is the last thing that this Labour government wanted to do. So going forward, they've got a budget coming down the track there. Again, we don't know exactly when, but it'll probably be at the end of October or early November. And the difficult choices are coming. And no wonder Rachel Reeves was finding the pressure really quite tough.
All right, Bloomberg opinion columnist Rosa Prince, we thank you so much for that. And it sets up our next conversation nicely. Let's bring in Yael Selfin, Vice Chair and Chief Economist at KPMG UK. Yael, always a pleasure to have you on the programme. Thanks so much for joining us. We heard there from Rosa about just how limited Keir Starmer's options are in terms of keeping the Labour left happy affordably. Do you see tax rises now inevitable when we look at the autumn budget?
Well, I think it's interesting because it does look like the Chancellor already had a bit of a gap to fill even before the announcement we've seen this week. She probably had around 22 billion that she would have needed to find in order to meet her fiscal rule. Now with the U-turn, she has something more around the 28 billion to find, and that's without leaving any room for maneuver, which she had originally. So you normally leave a few billions here and there. So we're talking realistically probably around 35 billion that she would need to find in the autumn if she wants to meet her fiscal rules. Obviously, focus changes, the situation changes, as may change, but this is how it is looking at the moment. She will need to find a way to fill that gap. Tax rises in some disguise or direct tax rises are probably one of the, option or a combination of that and some cuts to spending.
But surely more tax rises is only going to lower growth. So doesn't that just leave the UK in a doom loop?
Well, I mean, it depends a little bit of where the tax rises or the cuts are. I mean, there's different things that will impact the economy differently. I think confidence and less uncertainty is also very important. Ultimately, when you look at the labor market, it's relatively resilient at the moment. When you're looking at inflation, it's going down. So when you're looking at the overall fundamentals, they're not too bad. We're looking at growth that is more or less around the growth that you can expect without overheating, given the weak productivities that we have at the moment, which is what is starting to change. So I wouldn't necessarily say that we're going into a doom loop. What we need is to increase our longer-term productivity, potentially.
Well, so would that be a better option to raise taxes again than loosening the fiscal rules when we've seen the market reaction this week to any sort of chance that you have a more fiscally loose Chancellor?
Well, she's in a really tricky place. I think what the IMF came out in the previous report a few months ago, just calling for slightly more flexibility, seems quite sensible. The focus will change from one OBR event to the other, and it's very difficult for the Chancellor to change things every time we have a change in focus. Ultimately, these are forecasts, and there may be a call to try and look at things in a little bit longer term rather than keep changing the plans whenever you have a change in the focus, which inevitably you're going to have.
Yeah, I mean, is there something obvious that we're missing here in terms of how to get out of this fiscal nightmare? I was reading a note from Karen Ward at JP Morgan talking about how it comes back to the ageing population. Is there a silver bullet that you could see?
I don't think there is a silver bullet. I think there's a number of things we need to think about. One is we need to try and improve productivity. It's not enough to have public sector investing more. We need the private sector investing more. For that, you need more certainty. You need to encourage businesses to invest more. then we need to think about the way we deliver public services. We had the plan for the NHS delivery, but we need much more details around how this is actually going to be delivered. We need to make our healthcare more productive, and we need to try and make it live within its means, if you like, while delivering better outcomes for people. I think that is a big chunk of public finances. And then we need to find other ways to grow. So stronger relationship with our trading partners, in particular the EU, will help boost growth.
Yeah, you do kind of wonder whether that is the card Keir Starmer is going to play, closer ties with Brussels to fix some of this growth problem. Just finally, Yael, before we let you go, you know, the markets in the UK recovered somewhat since the sell-off earlier in the week. But the question remains, is there anyone that the market would like more than Rachel Reeves as Chancellor?
Well, I think the market would want some stability. The Chancellor was definitely saying the right things in terms of her plans for growth while living within her means. So I think markets will be very happy with the Chancellor that we have at the moment, as long as she can deliver.
I'm sure she'll like hearing you say that, Yael. Yael Selfin, Vice Chair and Chief Economist over at KPMG UK. Always a pleasure to have you on the programme. We thank you. Well, let's turn to oil, because OPEC Plus is considering another supersized output hike, despite the faltering demand for oil and plentiful supply. The price of crude has whipsawed, really, since the group's last meeting earlier this month, spiking at over $80 a barrel when the US bombed Iran's nuclear facilities, but quickly pulling back after last week's ceasefire. Now, OPEC Plus meets on Sunday, and ahead of that, we can speak to Bloomberg's Asia Energy Team Leader, Stephen Stapczynski. Stephen, thanks for being with us. What are you expecting to come out of this meeting? Is a production hike a done deal?
You know, nothing is a done deal when it comes to OPEC Plus, and they have the capacity to surprise the market. But what's widely expected, and what my colleagues have reported, is that we're seeing a 411,000 barrel a day increase over in the next month. Now, that is 3 times more than the plans at the moment, but they've done these kind of supersized increases over the last 3 months. So this will be the 4th one if they do agree to this. So yes, it is larger. Yes, it will add supply into the market, into a market that's already quite bearish and potentially could push down prices. But at the same time, it is somewhat expected because it's what OPEC Plus has done for the last 3 meetings. So doing it a 4th time perhaps is just essentially expected or priced into certain degrees in the market. Now, of course, if there's any variation to this, if they decide to do more, if certain countries are able to produce more than others, if they actually do less, then you could see prices react on Monday. But at the moment, we are expecting this 411,000 barrels a day number.
Yeah, and indeed, looking at the oil price right now, it seems like traders are more focused on the oversupply risks than what we're hearing on US-Iran, the US announcing these new sanctions on Iranian oil. Can you just tell us what we know about that?
Yeah, so the U.S. came out with another round of sanctions against Iranian oil tankers, as well as companies that are kind of circumventing restrictions to help the oil continue flowing, specifically with an Iraqi company. Now, this is interesting because the Trump administration has said that they are putting maximum pressure on the export of Iranian crude. But when you actually look at the numbers, actually Javier Blas, who's an opinion columnist for Bloomberg News, had a great piece just earlier this week on how, while the bombs have been dropping and while Trump, the administration, the Biden administration have been putting this maximum pressure, Iranian oil output has actually been at a record, not a record, but the highest level in decades. When you look at 2024 annual numbers, Iranian oil output was the highest level since the 70s, and its actually output increased briefly while the Iran-Israel war was heating up just a few weeks ago. So what's interesting is, yes, obviously the market wants to see whether there's a clampdown on Iranian barrels. If they do that, that would take oil off the market and lead to a price reaction. That would be a bullish element. But the fact of the matter is, there has been a lot of lip service to this strategy to help reduce or look to reduce output from Iran, and it hasn't really played out. The U.S., I guess, from both the Trump administration and Biden administration, the bark is louder than the bite, and the market somewhat understands that. So until there is an actual curtailment in supply, until there's evidence there, it is likely that traders aren't really expecting much reaction.
All right, Bloomberg Stephen Stapczynski, thank you so much. We'll let you go. You can go and enjoy your weekend ahead of that OPEC Plus meeting later on. Well, coming up on the programme, how Greece has transformed from emergency bailout to one of the best performing European economies. That story's next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, cast your mind back. In 2015, Greece was at the peak of its debt crisis, facing a potential default and even an exit from the euro. But over the past decade, Greece has made a remarkable economic recovery, transforming from an economic outcast to a poster child for financial prudence in Europe. Let's bring in our Athens Deputy Bureau Chief, Paul Tugwell, who's been looking into all of this for us. Paul, just remind us, what was the situation like in Greece a decade ago?
Well, I think it's worth reminding ourselves why we're talking about this now, is because exactly 10 years ago this week, there was a referendum organised in Greece on the terms of a new bailout package organised by the then left-wing Syriza government of former Prime Minister Alexis Tsipras. His party had been elected the same year on the promise to end austerity. And his government had advised the electorate to vote against the terms of the new bailout package. Of course, whilst that did happen, the government was forced to capitulate and apply the terms of the package as presented. Also worth remembering, the week before that vote, there was the introduction of capital controls in Greece to end exodus of capital, obviously. We were limited in Greece to withdrawing 60 euros a day at ATMs. There were queues at ATMs everywhere. And all of this in the backdrop of a country that had effectively been excluded from financial markets for 5 years, that had missed a deadline for payment to the IMF, where economic activity had virtually ground to a halt, where unemployment was massively high, and where there were violent demonstrations on a daily basis. And we didn't know at that time whether Greece would be either asked or forced to leave the euro area. So it was a very precarious situation 10 years ago, and it's the anniversary of that this week.
So that's the history, but let's look to now. What's the picture like today there?
Well, as you mentioned in your introduction, the turnaround has been quite spectacular. Worth pointing out the New Democracy government of Prime Minister Keir was elected for the first time in 2019. Since then, 2 years ago, Greece regained investment grade for the first time. The country's borrowing costs are now lower than Italy's. Even though the country has a high debt level, it's now on a sustainable path and is envied by others, some of the euro area partners. Economic growth is above the average for Greece's European partners. That said, GDP levels per capita are still lowish. Poland and Romania, for example, have overtaken Greece. There has been a marked increase in investment. Some big names have come to Greece in the past few years, such as Microsoft, Pfizer. Italian bank Unicredit was the latest to show its confidence in the Greek economy by increasing its stake in Greece's Alpha Bank. And many of the people that had left the country 10 years ago have started to come back. The government did offer some tax incentives for that. And whilst not everyone has come back, people are seeing that there are opportunities here and have decided to return home, as it were.
But Paul, when you talk about that recovery, is everyone benefiting from this turnaround equally?
That is a priority of the Prime Minister, Keir. He mentioned that this week, actually, given the anniversary of the referendum, saying his number one priority is to make sure that everyone benefits from this economic improvement. Greece, in fact, is one of the few European Union countries that's achieving primary surpluses, budget surpluses, and that is enabling him to be able to, for example, increase benefits. He's increased several times the minimum wage. There is more work around, but despite all of that, I think most people would agree that the benefits of that have been effectively cancelled out by the higher cost of living. As in many other countries, there were increased energy costs following the Russian invasion of Ukraine, but that was particularly marked in Greece. And still, many people are having to hold two jobs, even to just make ends meet, to survive. So while there's a general feeling that things are better, there is still a way to go.
OK, Paul Tugwell, our Athens Deputy Bureau Chief, thank you so much for bringing us that look back, the analysis now, and don't forget to read that big take on the terminal. Plenty more on the show. This is Bloomberg.
I believe a period characterized by such widespread uncertainty is no time for significant shifts in monetary policy. That is especially the case against the backdrop of a still resilient U.S. macroeconomy, which offers space for patience. And that's why I fully support the committee's wait-and-see policy prescription at our latest meeting.
Atlanta Fed President Raphael Bostic speaking there, and arguably yesterday's jobs data feeds that wait-and-see narrative. It was the fourth straight month in which US job growth beat expectations. You saw unemployment falling, and really it shows that this is a healthy US labour market despite the slowing economy, and that meant optimism for a potential July Fed cut plunged from 20% to 0%. September no longer fully priced as well, which means it could be a quiet summer for the Fed. How very European. Not in the monetary sense, of course, but if you just flip the board over, you can see markets are back to pricing in only 2 cuts for 2025. Now, that had powered the S&P to another fresh record just in time for the holiday, the Independence Day holiday. US markets are closed today, we should say. Volumes are going to be thinner as a result, but futures down now on President Trump saying that he will be sending out those tariff letters today. To whom? We wait to find out. But that does it for Daybreak Europe. Anna Val and Guy will take it from here all the way to the market open. This is Bloomberg.